Good afternoon, everyone. On behalf of KPMG, I would like to welcome you to the second webinar in our tax leadership series, which focuses on the OECD's BEPS 2.0 proposals. The OECD's work on BEPS has sought to harmonise the treatment of cross-border transactions and limit the ability of groups to move profits out of higher tax jurisdictions into lower ones. The latest instalment, BEPS 2.0, looks to go much further and represents a fundamental rewrite of the allocation of taxing rights between countries and seeks to put a floor on what rate of tax profits should be taxed at. The original objective of this work was to address digital companies in the digital economy, but it now goes much further than this and could affect companies in all sectors. This project kicked off in March 2018 with the consultation paper issued in February 19 and further feedback sought in late 2019. Most recently, the Inclusive Framework members met in early October of this year to get high-level agreement on some key policy features of the proposals. There were 5 key high-level points of agreement. Firstly, that the digitalisation of the economy has put pressure on the existing international tax system. Secondly, coordinated global tax rules promote economic growth and stability. Thirdly, that markets should be allocated a share of residual profit. Fourthly, a global minimum tax rate is desirable and is an effective backstop for anti-BEPS measures. And lastly, that improved dispute resolution is a fair trade for profit reallocation. So the OECD subsequently issued blueprints for Pillar 1, which deals with the allocation of taxing rights, and Pillar 2, which deals with the global minimum tax rate, on the 12th of October, and has opened these up for consultation, which is running now until the 14th of December. The OECD hoped to deliver a consensus-based solution by mid-next year, with additional time required following this for countries to implement the agreed actions into their local law and tax treaties. Both pillars are projected to increase tax revenues by about $50 to $80 billion, with most of that under Pillar 2. But there will be an intense amount of work done over the next 7 months or so there's a lot to discuss. So just some housekeeping before we start. The format for today's webinar will be an initial presentation by 2 of our partners, Carmel Logan and Killian Barry, on some of the key features of Pillar 1 and Pillar 2. Then our partner, Anna Scally, will lead a Q&A session with her US colleague, Jesse Eggert. Jesse is a principal in our Washington National Tax Practice, which is where our US deep technical experts sit. Prior to joining KPMG, Jesse was a senior advisor on the BEPS project for the OECD, where he led the work on the taxation of the digital economy. Jesse will be leading KPMG's global response to the consultation on the OECD blueprints, particularly around Pillar 2. We are delighted Jesse could join us today and look forward to hearing from him during the course of the next hour. Following Jesse's discussion with Anna, we will broaden the Q&A out to include Carmel and Killian, and also bring in one of our financial services partners, Gareth Bryan. Please send through any questions that you have as they come to you using the Q&A function, which you should find at the bottom center of your Zoom window. The questions will come directly into the panelists, and Anna will do her best to pick up these questions in the Q&A, but if we don't get time to answer them all, we'll respond to you directly afterwards. Again, thank you very much for joining us this afternoon, and Carmel, I'll turn it over to you now to kick things off in Pillar 1.
Thanks, Tom. So what is Pillar 1? It's a proposed new international framework against a backdrop that the existing arm's length principle is flawed, where more of the profits of global multinationals will be allocated to market jurisdictions, using a formulaic approach, referenced as Amount A and Amount B. Amount A is a new taxing right going beyond the arm's length principle. It captures profits associated with the active and sustained participation of a business in the economy of a market jurisdiction under new nexus rules and profit allocation rules, and regardless of a physical presence. Amount B is an existing taxing right, and it aims to standardise remuneration of related party distributors by applying a defined baseline return for distribution and marketing activities in market. With Pillar 1, it's intended that all countries would be required to abandon unilateral measures taken to tax the digital economy, like DSTs. Pillar 1 is a lot less developed than Pillar 2, which Killian will cover later. We have a much clearer picture of how the formula might work in the blueprint. There's lots of detail in the 10 chapters, but we want to touch on 3 main areas today. what's in and out of scope of amount A, the calculation, and then what's important to consider. So if we move on to the next slide, what's in scope for amount A is a key political issue. Some countries focus on the digital economy, but the US and China insist it can't be ring-fenced to digital. So two key areas have emerged that are within the scope of amount A: automated digital services, ADS, and consumer-facing businesses. The definitions are helpful, but they're broad and vague with lots of judgment areas. If we look at ADS first, it's not limited to B2C. It's defined by a general rule that you're in scope if it's automated and digital. It's supplemented by a positive list, which you're in, see some of them on the slide, and if a negative list, you're out. You can see that the positive list is similar to the EU list that covered DSTs, but significantly broader in some areas, such as cloud computing activities are potentially in scope. On the consumer-facing businesses, this targets businesses that generate revenues from the sale of goods or services, typically sold to consumers for personal use. It also includes, though, if you do this through distributors, agents, or intermediaries. So just because it's B2B doesn't mean it's not in scope. Franchising and licensing could possibly be in scope. And for those in the pharmaceutical industry, that's still to play for. There's two options in the blueprint. One option just includes over-the-counter drugs only, but another option outlined covers prescription drugs too. On the next slide, you'll see that helpfully there are some specific exclusions: natural resources and extractive industries, some regulated financial services, including banking and insurance, infrastructure, and then international air and shipping are called out as well. But there's a lot more work to be done on this. For example, it's not clear whether fintech is or isn't in scope. So you can see that those operating in the fintech or pharmaceutical industries aren't really out of the woods yet. Thresholds are important too. These aren't decided yet and are very political, but it is intended that it'll only be for the largest groups under amount A. The suggestion is that it's the C by C threshold, where consolidated group revenues are more than 750 million euros. But it's possible that that would be higher initially to target the most complex groups and then phase down over time. It's also recognised that if a business is mostly domestic, then they should be excluded from amount A. So there'll be a separate minimum foreign source in scope revenue threshold. Possibly around 250 million euros was mentioned. Again, it may be higher initially. And then there will be new nexus rules solely for amount A, which look at what's in scope and possibly exclude low nexus by reference to revenue. So 3 to 5 million euros was mentioned. So you can see that there's going to be a very significant number of countries that are potentially in scope. If we move to the next slide and look at how all this is going to be calculated, you can see that the diagram illustrates the decision tree for amount A and amount B. So if we look at amount A first, this is supposed to be formulaic. It's a new taxing right to allocate a portion of residual profit to market jurisdictions. It goes beyond the arm's length principle. The formula is applied to the tax base, which starts with your consolidated group financial statements. And there's three real steps. The first step is to work out a fixed profitability threshold. So this is your ratio of profit before tax to total revenue. And the idea is to isolate residual profit. A rate will be set for this. It hasn't yet been decided. 10% has been mentioned. So if, for example, when you did the ratio, your profit was 15%, then 5% would feed into the calculations and into the next step. So we go to step 2 then, and the idea then is that this applies a fixed reallocation percentage to determine the share of the residual profits to the market jurisdiction. So not all of the amount at step 1 is included, just a percentage. The percentage is yet to be agreed. 20% has been used in various examples. So in my example, it would then be 20% of the 5%. And lastly then, step 3 allocates that amount to market countries using allocation keys. Lots of details to be worked out, including any interaction with the safe harbour. The rates and percentages are very political. Pillar 1 is all about a reallocation of profits rather than being revenue raising. But the key question is the complexity worth the reallocation amount? If we look to amount B then, this applies to any company of any size. It's not restricted to the amount thresholds or to the industries we just discussed. But the idea is that it's an attempt to establish standardized intercompany pricing for baseline marketing and distribution activities. It's intended to be consistent with the arm's length principle. For now, it's restricted to buy-sell distributors. No rates have been announced yet, but the idea is that they will be benchmarked, but that there will be differences varying by region and by industry. And amount B is really important to developing countries, and they've been pushing hard to have this so that they get some more of the distributor profits. If we turn now to the next slide, what are the key things to think about when considering the blueprints? Most of the ones on the slide here are focused on amount A, which isn't surprising because it's new. If we look first at the group consolidated financial statements, the tax base will start with the measure of profits under approved GAAP. So US GAAP or IFRS would be approved, but not all will be. So for example, Irish GAAP wouldn't. And the idea is that you get to a typical tax base by adjusting out for permanent type differences, so stock-based compensation, etc. And the idea is that there'll be a similar tax base for Pillar 1 and Pillar 2. Those permanent differences or those adjusting items will be key in working out the rates. Looking to segmentation, the idea is that you identify in-scope revenue, that you source it to countries, and you multiply by a profit margin. But what margin? Is it the one in your financial statements, or is it a subset of that? In the previous slide, we talked about the 20-10 rule. So the idea is if your profitability is over a set margin, maybe 10%, then you're potentially in scope. But what if segments have very different margins? On a blended basis, you may well be out. But what if you had low margin out of scope, but then high margin potentially in scope? So segmentation may need to go beyond the financial statements. And what if the segments you've chosen in your financial statements put you at a competitive disadvantage to your competitors? Looking to Nexus, what will those thresholds be? It's clear that the new Nexus rules will go beyond the existing PE definition and will be broader. So will there be contagion over time? Sourcing is something that will be quite new, and there's significant complexities for taxpayers in this. So the intention is that you identify by revenue stream, not business type. So you look at what's the revenue type, what's the business model, and then what's the sourcing rule. And then there'll be a hierarchy of indicators and further steps to take if something is unreliable or unavailable. And really the key challenge for businesses to think about is how will you get that data? So matching what's in your operating systems with the financial data is going to be key. Others are loss carry forwards, elimination of double tax and tax certainty, and of course what's in and out of scope. But lots of open questions and more work to do in Pillar 1. But I want to hand you over now to Killian, who'll take you through Pillar 2.
Great, thanks Carmel, and good afternoon everyone. Pillar 2 is really where the rubber hits the road in generating new tax revenues, with the OECD estimating an increase in global tax of between 52 to 70 billion under Pillar 2. The overarching aim of Pillar 2 is to ensure that international groups pay a minimum level of tax, regardless of where they're headquartered or what jurisdictions they operate in. Therefore, if the tax paid in the jurisdiction is below the minimum rate, then a top-up tax will apply to bring the group up to that minimum level of tax. By imposing this minimum tax, the goal is to further reduce incentives for base erosion and profit shifting. However, it's worth noting at this juncture that these proposals do not impact on Ireland's freedom to choose its own tax rate. Pillar 2 is completely different to Pillar 1. It's not limited in scope, and it applies across all sectors, from technology to financial services, with exemptions only available for a small cohort of businesses, such as investment and pension funds. There will be a gateway test for Pillar 2 to apply, and it's proposed this will leverage off the country-by-country reporting threshold of 750 million in revenue. Now moving into the detail, Pillar 2 contains 4 new rules which to achieve this aim of a minimum level of tax, which you can see here on screen. But basically, Pillar 2 can be split into 2 distinct regimes which provide for a top-up tax. you have the subject to tax rule, and you have the globe rules. As we move to the next slide, we see the ordering of these rules. The subject to tax rule applies first under Pillar 2, and it is designed to restrict treaty relief on certain intra-group cross-border payments where the recipient is taxed at a low rate or under a preferential tax regime. These rules apply on a payment-by-payment basis, and the types of payments that are caught are those which are considered to have a greater base erosion risk, including interest, royalties, franchise fees, and insurance. The subject tax rule would operate by the payor jurisdiction imposing a withholding tax at a rate equal to the difference between the agreed minimum rate and a rate of tax in the recipient jurisdiction, and this withholding tax would apply to the gross payment. The gateway test for the subject to tax rules has not yet been agreed, but one proposal is to again follow the C/C threshold. For US headquartered groups, the question of whether guilty is grandfathered, which we'll discuss in more detail later on, is irrelevant for subject to tax, and therefore this rule applies to US groups the same as any other group. Unlike the globe rules, the subject to tax rule is not based on an effective tax rate, but instead applies if the payment is subject to a nominal rate of tax that is below the minimum rate. The minimum rate has not yet been agreed, but the examples in the blueprint use a rate of 7.5%. This could mean that payments to a jurisdiction which has a tax rate of lower than 7.5%, perhaps a Maltese fiscal unity at 5%, or say the Cayman Islands at 0%, or maybe even a territorial regime like Singapore, these could potentially be subject to further tax in the payor jurisdiction. An interesting point is that the subject to tax rules would be implemented by changing tax treaties. But as you will know, from an Irish perspective, our reduced rates of withholding tax on payments, such as interest and royalties, are often instead based on our domestic exemptions. And this is a point that would require further consideration from an Irish perspective. It's also worth noting that if Ireland was not to impose a withholding tax on such payments under the subject tax rule, then these payments may in any event be picked up in another jurisdiction under the income inclusion rule. The next two rules then are the income inclusion rule and the undertax payments rule. These are essentially two sides of the same coin. To add another acronym to the ever-expanding list, these are called GLOBE, which stands for Global Anti-Base Erosion. The income inclusion rule is a top-down approach with the top-up tax collected by the parent company. In this way, it could be seen as similar to existing CFC rules, however, it is much broader in scope. The starting point for these two GLOBE rules is to calculate the effective tax rate, which it is proposed will be calculated on a jurisdiction-by-jurisdiction basis. I'll come back to that in a moment. While the ETR in a jurisdiction, where the ETR in a jurisdiction is below a set minimum rate, then a top-up tax will be charged in respect of that jurisdiction. The rate of top-up tax is the difference between the agreed minimum rate and the ETR multiplied by the relevant income. This top-up tax is then allocated out. In the first instance, it's allocated to the parent company under the income inclusion rule. Or if the income inclusion rule does not fully pick up that amount, then the undertax payment rule kicks in to allocate the top-up to other group companies. The exact minimum rate of tax is not yet agreed, but thankfully it looks like it will be below 12.5%. For those of you working within US groups, this will no doubt sound similar to the guilty regime. However, there are a number of fundamental differences, in particular the more taxpayer-friendly worldwide approach to testing ETR under guilty. And a key open question as part of the consultation is whether guilty can be grandfathered as a qualifying income inclusion rule. I know Jesse will pick up on that later on. Two final comments on the income inclusion rule. There is a proposal for a substance-based carve-out, which will be based on payroll and intangible assets to allow routine income returns to labour-intensive and capital-intensive businesses. This reflects the focus of GLOBE on intangible related income and not on low-margin businesses. And secondly, there are 4 potential simplification measures also included and discussed in the blueprint, such as a safe harbour, and these will need to be discussed further. The final rule is the switchover rule. This seeks to allow the income inclusion rule to apply to branches and permanent establishments, which may otherwise be exempt under the tax treaty. So then moving to the next slide, as mentioned, the calculation of an ETR for each jurisdiction is vitally important. The formula is on screen and shows that the ETR is the covered tax divided by the tax base. The tax base starts with the profit before tax for the financial statements of the company, using the accounting standards of the parent company. So for US groups, this would likely mean applying US GAAP to all individual companies, and for Irish groups, applying IFRS. In applying the accounting standards of the parent company, intercompany transactions must be included based on an arm's length principle. So once again, having robust transfer pricing procedures is important. These accounting profits are then adjusted for certain permanent differences, such as dividends, stock-based compensation, etc. The definition of covered tax is very broad and essentially is all taxes on income or profits. But for example, it does not include turnover taxes, VAT, payroll taxes, or indeed digital service taxes. A potential issue with this approach is that the ETR is calculated by essentially comparing cash tax to book income, as deferred tax is not included. There are some proposals which would seek to address these timing differences, which could otherwise distort the ETR from year to year, such as accelerated depreciation. And there are also complex rules to cater for losses carried forward and excess taxes. I think a key takeaway here is that detailed accounting input would be vital as part of Pillar 2. A very quick point on implementation. The subject to tax rule would require an update to tax treaties, and this may be implemented using a multilateral instrument similar to what we saw under BEPS 1, whereas it is believed that the income inclusion rule and the undertax payment rule can be implemented by each country without changing their tax treaties. So the final slide here contains a simple example to illustrate the application of the Pillar 2 rules. So if we move to the final slide, we will see that there are payments of interest, royalties, and insurance to a company in a jurisdiction which has a nominal rate of 5%. In this example, jurisdictions B and C operate a subject to tax rule, and therefore these jurisdictions would impose a withholding tax at a rate of 2.5%, which is the difference between the minimum rate and the nominal rate, on the payments of €50 and €100 respectively, resulting in a top-up tax of 3.75. Jurisdiction D does not operate the subject to tax rule, and therefore no top-up applies under this rule. However, it is then necessary to consider the income inclusion rule. If we assume that the ETR in jurisdiction A, after incorporating the tax charge under the subject to tax rule, is 7%, this could result in an additional top-up tax of 3% in parent co. If parent co did not operate an income inclusion rule, then the undertax payment rule would kick in and would apply to allocate this top-up tax to the other jurisdictions. So as you can see, these rules are likely to impact on many tax-efficient structures currently in place. And at that, I'll now hand back to Anna.
Thank you, Cillian. Now I'm delighted to welcome our colleague Jessie Eggert from Washington National Tax to join our session today. You're there, Jessie? Hi there. Yep. Cillian took us through Pillar 2 there, the global minimum tax proposals. We hear a lot about guilty grandfathering. What does that mean? And would it mean that there's nothing for US multinationals to worry about if there was guilty grandfathering?
Yeah, so generally what's meant by guilty grandfathering is that guilty would be treated as a qualifying income inclusion rule, and there's an expectation generally among the participants in the conversation that if they want to get a consensus that includes the United States, there's going to need to be some concession to the fact that the U.S. has an existing regime that effectively served as the inspiration for the Pillar 2 rules, although it applies in using a very different mechanic. There are because of the different mechanics, there are some issues there that need to be worked out. The biggest is that, you know, while the general mechanics are different, at a high level, GILTI applies on a worldwide blended rate. Based on worldwide blended tax rates, and the income inclusion rule forces jurisdictional calculation of effective tax rates. Countries generally have seemed, you know, in the context of a political deal, comfortable with the idea that where an ultimate parent entity in the U.S. applies GILTI, it could be treated as a good income inclusion rule. There are questions to be answered, though, about what happens when you have a U.S. Company in the middle of a structure. They've generally taken a top-down approach to tiered income inclusion rules, in which the top company gets to apply an income inclusion rule, and the other companies, the other countries lower in the structure would relieve. GILTI doesn't have that feature of turning off if there's a higher level country applying its own rules, and figuring out how to deal with that is going to be a challenge. There are also, even if GILTI is a good income inclusion rule, there would continue to be challenges for U.S. headquartered entities, and in particular, receiving payments directly could give rise to liability under the undertax payment rules. The GILTI regime doesn't apply to the headquarters company that's in the U.S. And due to book tax differences, there may very well be situations in which a U.S. multinational could have an effective tax rate in a given year that's lower than whatever the minimum rate is. And even if not, unless there's some significant simplification, companies would still have to do all of those calculations to make sure. The second is that the subject to tax rule doesn't turn off depending on whether you have an income inclusion rule, and treating GILTI as a good income inclusion rule therefore would not turn off the subject to tax rule.
Yeah, so still really important for US companies to be engaged and interested in the discussion here. Let me turn to indicative tax rates and minimum tax rates that we might expect to see. So the blueprints included some examples where the tax rates were reduced from earlier discussion documents. Where do you expect the minimum effective tax rate to end up?
It's a hard question. I mean, ultimately, it will be a political decision. You consistently hear the notion that it will be somewhere between 10 and 15%, and that's, I think, not surprising. It's hard not to notice that 12.5% is right between 10 and 15%. That there's some amount of gravity, I think, towards that rate, but it's really not clear at this point where they'll end up. Okay.
Not clear, but I know we had Pascal Santaman talking to an Irish audience recently, and he did indicate 12.5 was likely a good rate, but we have yet to see. Actually, we have one question coming in that I might just ally to this that's just come in from one of the participants on my question of minimum tax. The question is, are you saying that Ireland will be compelled to impose a 7.5% withholding tax on outbound royalties to no tax jurisdictions? I think that is a reference to the subject to tax provisions that Cillian just spoke about. And I suppose what's important to say is the global minimum effective tax rate that I was just asking Jessie about was the, I suppose, a global effective rate that your rate should be no less than that global minimum rate. The subject to tax rules operate quite differently in that it is a withholding tax on the gross amount. So do you want to comment on that, Jessie, as well? Because it can be quite penal.
Sure. Yeah. The subject to tax rule is really intended to allow countries to impose as a defensive measure a condition that payments they make have to be subject to tax in order to attract treaty benefits. So if a country exempts particular payments under its domestic law, the subject to tax rule, I think, would have no effect. If it reduces rates under a tax treaty, yeah, the subject to tax rule could apply. It would apply only to countries that signed up to apply it. I don't think there's anything that would force a country to incorporate the subject to tax rule in its own treaties. I think it's an open question whether it becomes a minimum standard as part of this whole deal to force all countries, or to require all countries as part of the political deal to accept the application of the subject to tax rule by other source countries. I think that's more likely. And if so, you'd expect many countries to adopt these rules, but by no means do I expect that to be universal. And I definitely do not think that anything would force source countries to defend their own tax bases in ways that did not make sense for them.
Yeah. Ireland, as you know, Jesse, is home to a huge number of US foreign direct investment companies. Do you see these proposals having any impact on the attractiveness of Ireland for US groups?
Yeah, and there are a couple of factors at play here. One is to the extent we're talking about US headquartered groups and GILTI is treated as a qualifying income inclusion rule, I'd expect the impact to be minimal. As mentioned, the subject to tax rule may continue to apply, but absent some expectation that that's uniquely bad for Ireland as opposed to any jurisdiction, I wouldn't expect a big change. If GILTI were somehow not treated as a good income inclusion rule, you still have the question of where the rate is set. If it's set at 12.5%, there may not be a particularly severe impact, though a lot of pressure is put on how the effective tax rate is calculated, if that's the case.
Yeah, I think that's right. Can I turn to matters political in the US for a moment, given where we are in the cycle? So you now potentially have a new president on his way to the White House. That will likely result in a new head of the US Treasury. Do you think that could have an impact on the BEPS 2 process and where we're at currently?
Yeah, I mean, there are questions both of timing and of policy here. The impact on both is not terribly clear, so I don't want to overstate how much of an answer I have to any of this. If the goal is to reach a deal in mid 2021, there has to be a recognition that in a new administration would take office in January of next year. They will not have filled all of the relevant roles in Treasury when they take office. It typically takes some time. Chip Harder, the fellow who works on these issues, or who worked on these issues for the Trump administration, was not installed until August following the election. And that was an unusually slow process, but not orders of magnitude longer than one might normally expect. So timing for getting the relevant people into place will make a big difference to the ability to reach a consensus in a timely manner. In terms of policy, it's hard to imagine that a Biden administration would be more enthusiastic than a Trump administration about an approach that would single out U.S. business for special tax rules that would reallocate effectively the U.S. base to other countries. Unclear whether their response would be as heavily focused on trade sanctions as the Trump administration's has been, but I wouldn't expect a radical change in attitude towards the digital economy. With respect to Pillar 2, we will see. I mean, the Biden administration has made some proposals for changing the GILTI regime that would seem to bring it closer in line with the income inclusion rule, including taking a country-by-country approach. And that could have an impact on the dynamic of the discussions and on the positions the U.S. is willing to take. So time will tell.
Okay, and aside from BEPS 2, I know people on this side of the world are probably interested to hear, would you expect to see further reform of the US tax system more broadly with a Democratic president and a likely Republican Senate?
Yeah, I mean, to the extent the government is split, it does seem unlikely we'll see the kind of comprehensive reform that we saw in the last administration. There may very well still be some elements that change even with a split government. It does make significant changes, particularly changes of the type we're discussing now, changes to the GILTI regime, which was a sort of a centerpiece of the Republican tax reform. hard to see that changing as much as it might under a unified administration. Even frankly, under a fully democratic administration, the extent of those changes is not entirely clear. So a lot of uncertainty out there. I think fair to say less expectation of major reform with a split government than there would be if we end up with a fully democratic regime.
Okay, and a final question to you, Jesse, before we move to the panel. In relation to BEPS 2, Pillar 1 and 2, is it all or nothing? Or do you think could one pillar be introduced without the other?
Yeah, there's no technical reason why the two need to be linked. I mean, going back a ways, Action 1 of the BEPS action plan was focused really on the Pillar 1 type of concern, a reallocation of taxing rights from residence countries to market countries. The Pillar 2 stuff was added later in a response to concern that maybe the original BEPS project did not go far enough to address profit shifting, and maybe it needed a backstop in the form of a minimum tax. They were linked together because they were part of the same project. I think they've become politically linked together because there are different levels of enthusiasm among the various participants in the process for Pillar 1 versus Pillar 2. And the result of that, I think, is that the package together has more support than either of the pillars do by themselves, and there are potentials for trade-offs among countries. You know, a country that's interested in Pillar 1 might be willing to make a concession with respect to Pillar 2 if it gets what it wants under Pillar 1. That dynamic has meant splitting the two apart is challenging. In particular, right now, the U.S. has expressed the view that it's more interested in Pillar 2 than it is in Pillar 1, and I think splitting Pillar 2 off and moving forward on that would be seen as a pretty significant concession to the United States that a number of countries have expressed reservations about so far. So that's a long way of saying I don't think it could happen in the short term. If consensus somehow does not come together for a big package, I think you could see countries moving to do something, you know, themselves about either of these, and if that's the case, you know, it's anybody's guess what goes forward where.
Well, that might be a good time for me to ask Carmel and Killian to rejoin us, and also for Gareth Bryan, who is a partner in our financial services group, to also join us. Excellent. Thank you, Gareth, Carmel and Killian. And Killian, you're on mute, so just in case. Before we get into a further panel discussion, and just to make sure that all of our participants online are still awake, we're going to kick off with some polling questions that we want to put to the participants. I'm assured this is a very simple process, and so what we're going to do is launch 3 questions. One first, and then we will comment on it, a second one and a third one. And I believe they're very straightforward, and I would appreciate if everybody online could participate. So the first question is quite a straightforward one, but not sure what the answer is going to be. And so if we could launch our first polling question, it is, will consensus be reached by June 2021? And there are 2 answers, yes or no. So I would invite the participants to give their view on that. And if we have a result, we could put the result up. Whoa, so the result is an overwhelming no. 86% of those who responded have said no, and 14% have said yes. Jesse, if the answer is no, what do we expect to see? Or what could happen?
Yeah, I mean, important to remember how we got here. Part of the reason why Pillar 1 discussions have gone as far as they have is because of concern that unilateral measures by countries were starting to proliferate around the world. Some of that has slowed down as progress has been seeming to be made on Pillar 1. It hasn't stopped. Measures that were already out there have kept going. But I think if it seems like things are falling apart, you can expect that those unilateral measures will start up in the form of digital services taxes, in the form of equalization levies, in the forms of other measures designed to address this particular question. That has, previous efforts have led to, the threat or the threat of trade sanctions from the Trump administration. Unclear, as I mentioned earlier, how big a feature that will be in a response from a Biden administration, but there is a risk there.
Okay.
We've seen some U.S. multinationals already reacting to digital services taxes by passing those costs explicitly on to customers, and we've seen the U.S. government react by proposing that our foreign tax credit rules would not credit digital services taxes or other levies against digital companies. All of those factors seem to be in play in figuring out how this thing will go forward.
Okay, let's move to our second polling question. And again, it is a reasonably straightforward one. Are you, I suppose, as a tax professional or as a senior professional in a company, are you most concerned about Pillar 1, Pillar 2, both, or neither? And remember, Pillar 1 is the reallocation of profits to market jurisdictions, and Pillar 2 is aimed at securing a minimum level of taxation. So maybe if we could launch the result there, if there are some answers in. Oh, interesting. Some Pillar 1, Pillar 2 is winning there, both or neither. And that is quite interesting because maybe Pillar 2 and the response there is because it will have broad application to all industries. But obviously we know Pillar 1, may well have implications far beyond what we expected. So that's really quite interesting and split. I think it's something we need to keep an eye on, all of them for the time being. So our third and final polling question, this is a little trickier. So if we could just launch this, and we might give people a minute or two to respond. So the question here is, what issue is your organization most concerned about? Impact on effective tax rate, ability of financial and operating systems to deliver the information that will be required, the complexity and interaction of the tax rules in multiple jurisdictions, or the cost of compliance. So if we could launch the result there, we will see how it is split. Oh, again, heavily split. We've 33% worried about the impact on effective tax rates, 48% concerned about the complexity and the interaction of the tax rules in multiple jurisdictions, only 14% concerned about the ability of financial and operating systems, and 5% on cost of compliance. And I expect the answers are probably most people are concerned about all. The question was just, what are you most concerned about at this point? And actually, Carmel, may I ask you maybe to respond and give me your thoughts on the response to that final polling question?
Yeah, thanks, Anna. I don't think that result is surprising. I think from talking to clients and thinking about this, the concerns around complexity are significant. I think it draws out a few things that people need to think about in thinking about how they might respond to the consultation is, how the new tax rules are calculated show the importance of working closely with your accounting folks. So Killian and I both touched on the starting point for the tax base is the consolidated financial statements, but what those permanent differences are, difference book to tax, all of that is going to feed in. And as you can see in terms of the formula and the calculations can have differences. And then for those that are in the scope of Amount A, the sourcing rules really are complex and they vary by revenue stream, and tax won't have focused on those before. Like there's lots of different allocation keys and indicators. Key question is how do you get that information from your operating system into your financial system? So it's a real challenge for those clients that are within the scope of the unilateral DSTs that Jessie mentioned. So we've been working with clients to develop processes and technology solutions to assist with that using kind of data extraction and data warehousing tools. But when you look through the blueprints, the integrity of all those controls and processes that you're going to be put in place, that's possibly what's going to be audited rather than the underlying data itself. So, for those likely to be in scope, you really need to think early about, what you need to do, because it's going to take time to develop all of that. So I'm not surprised that complexity is top of the agenda for most people, or topic of concern.
Great. Thank you very much, Carmel, and thanks to everybody for participating in those polls. Can I bring Gareth in? Gareth, specifically financial services. How is the financial services sector going to be impacted by these proposals?
Yeah, thanks, Anna. I'd say it's a game of two halves, really. So Pillar 1 is likely not to be that important for traditional financial services business, if I can put it like that. And that's because Amount A explicitly excludes banks, insurance companies, and funds and sort of asset management related entities such as managers and some of the intermediaries. The rationale for that can be loosely summarized as saying, well, financial services that are regulated, well, regulation generally requires substance. So to a certain extent, there's already something driving people and profits and activity to the right jurisdictions. Now, that rationale, I think for most of us, will ring hollow in certain cases, particularly when we see the number of financial services type products that are now available digitally. And it is for that reason that, as Carmel alluded to earlier on, there is still quite a doubt around the position of fintech companies. And are they going to be caught or not? And the report says that it would be consistent to exempt fintech companies where they're performing activities that are similar to traditional banks or presumably other traditional financial products. But that not necessarily to go so far where they're providing activities that are more in line with other non-regulated services. And indeed, there are plenty of fintech type services that are would fall under the automated digital services category or consumer-facing business. But for those kind of core traditional, if you like, white-collar type activity, that's probably going to be protected. Amount B doesn't specifically exclude financial services, but it's likely to be less relevant generally to financial services because of its focus on fixed reward to distributors. Noting that the report does say that there are some members who think that agents of certain categories should be included, so potentially that could widen out. Worth bearing in mind that the status, in particular Amount A and possibly B, depending on how broad it becomes, for unregulated or less likely regulated financial services is still going to be a question to be considered. So things like consumer finance, if it's not banking, it's not traditional banking, will that be covered? Hire purchase type products, hire purchase arrangements around consumer goods, laptops, cars, that kind of thing. Non-bank lending, there's lots of non-bank lending out there feeding into industrial and consumer markets. Peer-to-peer lending, will that come within those exemptions or not? So still a fair amount of uncertainty for some of those non-traditional financial services businesses. Pillar 2, on the other hand, no carve out for financial services, and interesting that the rationale for those exclusions for financial services in Pillar 1 just hasn't followed through here. It seems to be, just not considered. In Pillar 2 then, there are exclusions for investment funds, sovereign wealth funds, pension funds. The definitions of what qualifies in these categories is going to be really important to see what is in and what's out. So for example, funds are presumed to have multiple investors. So a fund of one typically wouldn't qualify. It's interesting, generally what the report says is, yes, we might exclude the fund or the pension fund or the sovereign wealth fund, but not companies beneath it unless they were pure holding companies. Interestingly though, what difference that does make is that by having a fund vehicle at the top of the group, that actually potentially, under the terms of the report as written, would separate out any individual businesses beneath it. So say a sovereign wealth fund that owned multiple businesses in different jurisdictions, they might be counted separately for the purposes of determining whether they're within the 750 million limit. So you could find a very large fund could have an advantage by having different businesses owned underneath that structure if properly organized. In terms of specific FS businesses under Pillar 2, I think the real challenge is going to be for insurance. A lot of insurance, as people will know, is in Bermuda. There won't be tax in Bermuda. So even if Bermuda were to say we'd like to play ball in terms of participating, income inclusion isn't going to capture them because there isn't any tax to pay in Bermuda anyway. So I'd say going to be significant issues there, likely into the more complex UTP or under tax payment rule for insurance groups headquartered out of Bermuda. Apart from the amount of additional tax, it just drives a lot of complexity when you're into the UTP, or far more complicated to work out allocations of payments under those keys. As a general comment, income inclusion rule where it applies, it's going to be difficult to mitigate. If you're in a jurisdiction, an ultimate parent jurisdiction that has that rule, difficult to mitigate. The UTPR, potentially there's more scope for income to fall out of scope there, particularly if you could earn income, third-party income into the parent jurisdiction. If it's not a participating jurisdiction, if you can earn that indirectly, might have less tax to pay than under an income inclusion rule, but a lot more complexity in terms of implementation. So in summary, Pillar 2 doesn't apply to financial services, but transfer pricing and working out how you're going to allocate payments, working out those keys, what payments belong where, that's going to be very complex for an area that already is complex.
Great, thank you. So financial services squarely within Pillar 2 there. You mentioned transfer pricing. Carmel, you might just pick up on transfer pricing. What impact does Pillar 1 have on transfer pricing and the arm's length standard as we know it? And is transfer pricing still important?
And I think it's going to be as important as ever. OECD is seeking to bring consensus to prevent unilateral actions that Jesse mentioned earlier. So it's really political, but the blueprints work on the premise that the arm's length principle is flawed in highly automated and digitized businesses. But the arm's length principle still drives the basic allocation of all the profits. So if you think about it, the new amount A is like a sliver on top. So when your profit margin is above a certain percentage, maybe 10%, then only a fixed percentage of that, maybe 20%, is then allocated to markets based on allocation keys. So it's also worth remembering that amount A will only apply to the largest groups. I think in the documents, and the in-scope areas, obviously. The OECD, I think it estimates in the blueprints that there's about 2,300 multinationals maybe in scope. So you can see there's a whole host of groups not in scope of amount A because of size, profitability, or activities. Amount B is broader and it can apply to all groups, but currently as drafted, it's only for buy-sell distributors. So it's still going to come back to who controls the functions, assets and risks, and where DEMPI functions are and where substance is located. That will still drive a large amount of who earns the residual profits and respecting the arm's length principles. I think under the current rules, our transfer pricing colleagues are seeing a significant increase in audits and MAP requests. But there's a lot of focus in the blueprints on tax certainty, but we still see significant scope for disputes and challenges. And I think the dispute resolution mechanisms will be critical, but we still see the arm's length principle very much playing a role in resolving those disputes. So I don't think it's going away.
Okay, thanks. And Cillian, can I ask you a quick one just on Irish headquartered groups before we move on to our final piece, which will touch on the consultation itself. So, question, Irish headquartered groups, say minimum effective tax rate 12.5%, do they have anything to worry about?
Yeah, I think, Anna, if the minimum rate is below 12.5%, this would hopefully exclude the profits that are taxed in Ireland at an ETR of 12.5% from Pillar 2. but Irish groups definitely need to consider the income inclusion rule in particular. As any jurisdictions that they operate in that has an ETR below the minimum rate may be subject to a top-up tax in Ireland. Now, for example, this may directly impact tax-efficient financing structures. And then, like other groups, Irish groups will also have to grapple with just the complexity of these rules and the accounting implications and just the overall compliance process as well.
Okay, and then Jesse, I want to turn to you and then maybe just get the others to follow in on this, on the consultation itself. Tom mentioned at the beginning of the session, the OECD has opened these blueprints for comment, and we have until the 14th of December to respond. The consultation document itself is 14 pages long. It asks 12 questions on Pillar 1 and a further 10 on Pillar 2, and there are a myriad of areas they're looking for comments on. You are going to be putting together KPMG's global submission, particularly around Pillar 2. You're ex-OECD yourself, so you know how these consultations roll as well. You might just comment specifically on some of the key areas that you will be covering in the KPMG response to that consultation.
Sure. Probably worth noting up front, they asked a lot of questions about Pillar 2 and about Pillar 1. None of them are the political questions. They seem comfortable with the idea that they don't need the business community's input on the politics, which is fair, I think, although I suspect a lot of folks commenting will not be able to resist weighing in on questions like thresholds and rates. A few things to highlight. I think one of the key focuses is going to be on the monumental complexity of Pillar 2. There are a few ways in which that makes itself challenging. One is the focus on book income means that where there are substantial differences between tax and book, you have a choice between creating timing problems that could result in fluctuations in effective tax rate, or creating additional complexity by having to incorporate those book to tax differences. They've opted with relatively few book to tax adjustments and a spectacularly complicated system of carry forwards and carrybacks to try to address smoothing over time. They have announced that they are considering a number of simplification measures. None of them are particularly fully baked, and one of the places I think where we will focus is on providing some input with respect to those simplification options. In particular, they've suggested possibly doing an effective tax rate calculation based on country by country reporting, which has its own problems because they seem to be contemplating adding to the amount of stuff that people will have to report under country by country reporting in order to cause that to simplify the Pillar 2 process, which is a bit of sort of putting the cart before the horse. They've suggested, allowing a single ETR calculation to stand in for multiple years, which, you sort of scratch your head and wonder, does that really save anyone any time? And they've suggested administrative relief. Countries get together, agree. Some countries may have a high rate and a broad base that is similar to the Pillar 2 base, and do companies there really have to do a calculation every year if that's the case, or can they simply certify, I'm in a good country, no one should expect my rate to be below the minimum rate? That obviously has the potential, if they can follow through on it, to have massive simplifying effect. And so hopefully that will be pursued further. Other areas to touch on, the guilty coexistence and how that might work in practice. Making sure that rules with respect to intragroup reorganizations and intragroup transactions are treated appropriately. How to deal with investment funds and other tax transparent entities, making sure that losses are appropriately accounted for. That's a key issue for both Pillar 2 and Pillar 1, where countries are sort of, there does not seem to be consensus yet on how that will work. I think countries have historically always been concerned about how far you reach back to bring in losses to a new regime. This is no exception. People want revenues now, and the more losses they recognize, the fewer revenues they get. So that's a sort of broad overview of some of the key issues we'll be looking at in Pillar 2.
Okay. And I might just give Killian 30 seconds on what do you think the key areas are that Irish businesses and subsidiaries of US multinationals might want to see some commentary on in those consultations. And then I'll ask Gareth for 30 seconds for FS. Okay.
Yeah. Thanks, Anna. So Jesse touched on intergroup transactions just a moment ago. I think that certainly would be a key one. And while it's broadly accepted in the blueprint, intercompany transactions should be respected. The consultation does have an open question on group reorganizations, and intergroup transactions would of course include buying and selling assets such as IP, which I think would be very relevant for a lot of our clients and very relevant for Irish clients. I think it's also important to ensure that companies who avail of things like R&D tax credits and the knowledge development box, that they aren't going to run into difficulties in calculating their effective tax rates. As it stands at the moment, it looks like R&D tax credits will be okay, but the KDB may not be. And I know we touched on this again, just to re-emphasize, I think it is quite clear that things like financing structures in particular might be impacted via the subject to tax rules, and then of course the income inclusion rule as well. So they're all a very quick snapshot of key issues that Irish businesses need to be aware of.
Great, and an even quicker snapshot, Gareth, for financial services organisations, particularly maybe a touch on leasing.
Yeah, leasing. So as I said, Pillar 1 exclusion for financial services doesn't cover leasing or hire purchase. So that's generally not going to be an issue for big commercial lessors, people leasing aircraft, industrial equipment, but consumer leasing products could be caught. So worth thinking about those and the kind of related businesses like receivables financing, which is a really important way of financing those businesses. Pillar 2, that's the real issue for leasing. I think you need to think about the jurisdictions that you're operating in and are they likely to be caught by that threshold tax rate, the ETR rate. And really important issues in that will be the adjustments to accounting measures. So accounting measures, particularly around depreciation compared to accelerated capital allowances, which is common across many jurisdictions for leased equipment. Really need to make sure that those adjustments are factored into the final version to make sure it's going to be feasible. Otherwise, leasing companies, even in high rate tax jurisdictions, could be caught. Attention also for special leasing regimes, things like tonnage tax for shipping. Report does acknowledge that that's a thorny area, but that could make predictability very difficult when you're into a completely different measure of taxable profits. Finally, don't forget, subject to tax rule could deny treaty benefits for leasing groups, bearing in mind that they can potentially deny treaty benefits depending on where that lessor in this case is based. So not to be ignored.
Well, thank you. I'll have to cut you off there. There is a huge amount in that. So thank you very much for your contributions. And also thank you very much for the questions that came in. And for those we didn't get an opportunity to answer, we will endeavour to follow up with you directly. It's very clear from our session today that the proposals set out in the blueprint are hugely complex. It's very uncertain what the final outcome is going to be. It is really critical that each of you assess the impact that is likely to occur, or the impact of these proposals on your company. In relation to that, I know Carmel had mentioned tools, and we have developed a BEPS 2 tool to try and assist companies in assessing the impact. It's also critically important to engage and lobby on the areas that are going to be of particular interest to you as organisations. And we've touched on a number of those areas in our discussion today. We've also started to do some workshops with a number of our clients who are keen to really delve into the impact of these proposals on their business. And if any of you listening are interested in those, please do reach out to one of us or one of your KPMG contacts. Please don't forget the consultation ends on the 14th of December, and KPMG will be finalising our response over the next 2 to 3 weeks. These proposals, as we've outlined today, have the potential to fundamentally change the way in which companies are taxed. And while they are aimed initially at larger companies, invariably the principles and the issues that emerge will bleed into the mainstream. So it is really, really critical that companies at all stages engage. Finally, I would like to say a big thank you to our speakers today, and especially Jessie. Thank you very much for your contribution, and thank you to all of you for joining us today. We really look forward to sharing our slides and our contact details, which we will do with you later, and we look forward to engaging with you further on this very important matter. Thank you very much indeed, and have a lovely afternoon.